Hey guys, wanted to do this video real fast because someone asked me why I chose to do the blind pool fund model versus the syndication. And number one reason why, and I was sharing this with them and I will share this with you guys. The main reason why I did that is because I'm in a very competitive market. I learned how to kind of really do multifamily the right way in Hawaii. And now I'm in San Diego. So if you know anything about San Diego, multifamily real estate, any real estate, you have a lot of high price properties and it's a very competitive market. So knowing that I've spent the majority of my 20 plus year career in real estate with a noose around my neck dangling, get the deal and then go scramble to raise the money right after that. And that's a nightmare. And the bigger the deals get, the bigger the nightmare. So rather than put myself in that situation when we sold everything and we moved here, I was like, look, I don't want to go through that. I went after a couple of deals. Every time I was on a deal, there was like 10, 15, one group, one deal that we looked at, there was 50 property tours at this multifamily deal. It was a 350 unit apartment complex, 50 groups walking. There's no way to get that deal. If you have to go syndicated, that is not how this game works. So number one, I'm in a competitive market and I wanted to separate myself from the other syndicators out there. So if they do come across a broker, the broker's biggest fear is like you're not going to close. And if they know that you're a syndicator and you have to go put together the money in hopes to close, they they're probably not going to pick you. You're not going to be their second, third, or first choice. You're never their first, but you're probably not going to be the second, third, or fourth if that's the case. So that's number one. I'm in a competitive market. Number two, I started studying the top of the food chain and looking at really what they did. So you have, yeah, I mean, really, when you take a look at for me, the groups that are doing what I want to do, not mom and pops and other syndicators and gurus out there that are online, but like what is Bell Capital? What do I want? So I studied the top of the food chain. So I look at Blackstone, BlackRock, Starwood Capital, Graystar, MAA, uh, every other group out there that's in private equity real estate, they actually raise the money first. They don't actually syndicate. They don't go find the deal first and then put together the money. They raise the money first in a blind pool and then they go and they buy the deals. So I wanted to do that. So my attorney, when I talked to my attorney Nate, and, and Richard and Jillian, they were like, it is a lot harder to do a blind race. So if you're going to do the fund model, just know that it's going to take a lot more work. It's going to take a little bit longer than you expect, and you're probably going to really be pushing hard. I didn't know it was going to be that hard because raising capital is hard, guys. I mean, just to be honest with you. But I'd rather do it that way because I have a mentality like one, they said it was going to be hard and I was probably not going to be able to do it very, very well. So that was kind of a personal thing for me. Usually, if somebody tells me I'm not going to be able to do something or it's going to be tougher for me than everyone else, that's probably the route I'm going to go because I'm a little bit of a rebel. Number two, I know that if it's hard for me, it's hard for everyone. And if it's hard for everybody, then I got a chance. So I'd rather be in a situation where I have a better chance to make a big score, to score something big, and it's hard for everybody, and we're all pushing to do that, than to do that because that's exciting for me and that'll keep me interested for a long period of time. So that was huge for me to be able to do that. So the thing that I like to share with people is this. The other thing between a blind pool and a syndication, I guess it's the same thing for a syndication as well, but this this is important. I guess it's all important. It's business plan specific, right? So you need a business plan. So number one, like what does your deal look like? So whenever we're looking at a real estate deal, I already know that we're looking for an A class location, A to B class property that's about, 10 years old. It's a newer property. It's already full. It's already somewhat stabilized. There's a little bit of upside in increasing the rent. I don't have to go and fix anything. I just need to go and take over the rent and treat people good. That's a deal. That's my business plan. The other piece is I need to know what type of debt. That's first. So number one, we're looking, this is the business plan, right? So number two, what kind of debt this property is going to be able to support? Can we go to a Fannie Mae, Freddie, a life insurance company, or a debt fund? Like, who's going to fund this deal? And if I know from a business plan perspective, our debt partner, which is my number one partner in every deal, we're going to raise 60% of the money or 65% of the money from our debt partners, like whoever we're getting the funding from, right? So they have to like this deal. That's my business plan. So we know, hey, great deal, great location, and we need to be able to get great debt on this property. Even if right now the debt market is not as friendly, we need to know that at some point, any lender is going to like what we're looking at, and that's a part of my business plan. And if it's good for the lender, if it's good for Fannie Mae or Freddie Mac or a life insurance company, it's got to be good for my investors too. It's got to be good for them. It's good for us. So, and that's when I look at my equity. Right? Again, this is about going after the doing a blind pool fund instead of just doing the syndication. So in this situation now, I'm like, hey, the equity, can we get 5% to our investors? Could we get double or triple our money at the end of their deal? Because we're looking for a 15% internal rate of return over our hold period, which is broken down in between cash flow, which is the 5% over a period of time. And later, hopefully, our goal is to refinance, which is my business plan, refinance the property, take out our equity, and then give that back to our investors, and then keep the property for more cash flow, and then later come back to market and either refinance and take out more equity because we've raised income and the revenues and stuff again, take out more money, give it to our investors, we make money at that time, or we exit the deal and we sell. And then during that time, can we get two to 3x on our money? My target's always two. If I can hit two, I've always done over two, but if I can hit two on the exit over a 7 to 10 year hold, I'm going to do that. But when you have a blind pool or you're raising money in a blind pool fund model, your business plan is the most important thing. You got to know where your deals are coming from. You got to build a relationship with your brokers. You got to build a relationship with your debt, the debt people, all the people who are going to get the funding, and know that you're going to get good debt. And your investors have to know that what is your plan? What are going to be the returns? How long are we going to be in the deal? How do you mitigate risk? Well, this is how I mitigate risk. One, the deal has to be a great deal. Number two, I mitigate it because my debt partner is going to say, hey, Vic, not this deal. Or we don't like this deal, and here's why. If you can change these things, or if we can go back and renegotiate, here's what we would like to see. Here are the targets that we got to hit. So I just backed all this stuff in because again, what a lot of people don't know about me is my first business partners in my deals, they had a mortgage company. So I really started off in finance. Even though I was doing real estate, my business partners had a finance company. So they had a mortgage company. I learned how to underwrite deals and debt, finance, spreads, yields, how they work together. And then they were my equity partners. So I learned, how does the equity partner get paid? How do they do these things? How do you structure the deals? And I mean, be honest with you, truth be told, my business partners, they raised capital too. They raised money and then they lent that money out from a mortgage perspective and then they got paid on the fees. So like I understood how all this stuff works, which is why to me, like I said, studying the top of the food chain and other private equity companies, they raise capital first. So they're doing a blind pool fund, and that's what I wanted to do. So other syndicators, they don't do it that way. They may start off with the deal first, but then they're like, hey, we're got to go raise the equity. Let's try to find the best debt. So the business plan may be shot. Even if it's not shot, it can be shot because the noose is around their neck. Once they have a deal tied up under contract, they write that check. Now they're like, oh man, they're scrambling. So sometimes they may make mistakes. We don't have to do that because we're business plan based first in the blind raise that we're doing. So, I mean, and it's easy, right? Like from the perspective of how do you get involved as an investor, naturally, we talk to you about what we're doing, just like I do now. That's why I do this here. I mean, the reality of it is I do this so you get an understanding of what it's like to invest with us, how I underwrite deals, how we underwrite the returns to our investors. I do it over and over and over again. So, because that is what I do every time, is what I've done in the past, is what I'll continue to do in the future. I'm only doing what worked. So naturally, you're going to take a look at it. We're going to share our business plan with you. We'll show you a couple of deals we're underwriting and targeting so you get an idea of what we look at and why. Then you're going to walk through the paperwork with you. We're going to find out what your actual needs are as an investor. Some investors that we talk to don't need the cash flow. They're like, hey, we make a ton of money in our business or our jobs. We have high income. So we really need the write-offs from the real estate investments. And we also were looking forward to the appreciation for the future because we're looking for generational wealth. And naturally, everybody wants to double or triple their money in the future with some type of tax benefits and leverage and things like that to kind of continue to boost their balance sheet. And to know that, hey, we have a deal like that. Let's say, hey, look, in this deal, we think the appreciation on this deal is going to be here. That's a better thing. And then after that, you say yes, you do your paperwork or your subscription agreement, and naturally, you got to be accredited. You do your subscription agreement, you get that over, we get it back in, and then that way we know, hey, look, this person has already committed X amount of capital. When we have a deal, I talk to my brokers and they feel more comfortable about it because we can say, look, we have already raised the money. This is all the money that we have committed. And then when it's time to close, we pick up the phone, and then that committed capital gets called in. It's called, we have a call for capital. Everybody wires the money in and we're all good. That's the difference of somebody doing it this way. Is it risky? No, not really. Because what's risky is not being able to close the deal and having the risk by saying, hey, we locked up a deal and then we go out to try to hunt. And man, that's stressful. I did that for 20 years. I don't want to do it again. And now I think it's a lot easier to communicate with you guys, whether it's on YouTube, whether it's on Instagram, Facebook, LinkedIn, or whatever. So you understand what we're doing and whether you want to do it with us or not. So I hope this helps you. Now, if you're a syndicator, it doesn't mean it's wrong. There's a ton of people doing a great job at syndication. It's just not the way that I wanted to go because I didn't want that noose around my neck, man. I'm tired of that. So, if this helps, great. Give it a thumbs up. Give it a thumbs down if you hate it, or if you have questions about this, like what did you get from this? Would you invest in a blind pool or do you like the syndication model? Or if you were going to be an investor in one of these deals, would you rather invest with a syndicator that has a deal tied up and you want to put your money in after? Or are you okay with saying, hey, look, I like the model and I get to see what's coming down the pipe because I'm pretty transparent. I'll show you. And I'm okay with saying, hey, look, I'm just going to commit a certain amount of money. And then once that, I mean, it through paperwork, and once you have that, the deals are ready, you're going to do a call for capital. I'll do the wire. Now, even in those situations, I have people like, hey, we may have a deal, we may have a call for capital, and somebody goes, I don't want that deal. And they're going to lose that spot because I'm going to continue to get people subscribed and ready to go inside the fund. And that's cool too. No problem with that. That's the benefit of having a fund. We can raise capital all year until we have the opportunity to close that fund out. No more deals go in. You can't put any more money in there. And then we set up the next fund to be able to go from there. And then you can jump in that one. So that's how I did it. I think it's a long standing running business. I'm going to do this for a long time, building a big organization, a big company. So that way we take care of our investors for 30, 40, 50 years, long after I'm dead and gone. I really want to become a bank in my lifetime, towards Bell Capital moves away from it being about Victor Bell and it becomes an institution like a JP Morgan or a Goldman Chase or a Wells Fargo. So that's my goal. But anyways, I appreciate you guys. Go to bell-capital.com. You can do two things there. You got to be accredited to invest with us. It's an accredited only fund, meaning you make 200,000 a year or you have $1 million net worth excluding your primary residence. And you can do two things. You can schedule a call and we can talk about your specific situation and we're here to answer your questions, or you can hit it, get started or invest, and you can go and you can take a look at our open fund. You can register there so that way you can register on the portal. Do your due diligence, take a look at the documents. You can still schedule a call and talk to us if you have questions about how it works, your specific situation, and we're here to help you. So again, leave those questions. What do you like? What do you don't? What do you don't you like? Would you do this? Would you not do this? Would you do it on your own, or would you just want to do it with someone else? All right, leave me in the comments. I appreciate you. Leave that message in the comments. I appreciate you guys. Have a great day today. Let's get after it. Boom.